In this week's video, we'll answer the question, are things getting better or worse for the stock market bulls? We'll kick off the video by looking at the current readings of the CCM market model. We'll examine the first signal that was given in early February. We'll review 2 ways to monitor risk from a long-term perspective. We'll quickly go through 6 risk monitoring charts that the market model uses. We'll do an update on that broad market breakout. We'll explore the question, I can't buy at all-time highs, right? Look at trends, S&P 500 weekly, NASDAQ weekly, and Dow from a daily perspective. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a screenshot of the master spreadsheet for the CCM market model. These are the sub-models that feed into the master model and help us answer the question, what's a prudent allocation to risk assets and conservative assets based upon the observable, unbiased, and objective evidence. Here, on February 6th, it was 35% risk, 65% conservative. Why? The market did not look good. The risk-reward profile was deteriorating. And what we try to do is put our capital in harm's way when the odds are in our favor and decrease our exposure to risk when the odds are deteriorating, as they were in January and February. We began to see improvement, observable improvement that we tweeted about on February 7th. An incremental buy was made on that day. We went from 35 to 47 on the risk side of the equation. If we fast forward to the present day, this is an intraday figure, not a final figure on Friday, March 7th, but the final figure should be close to that, maybe in the high 80s. We're at 90% risk, 10% conservative assets. Does that mean the market's about to peak? No. Markets can continue to rise for weeks or months with this type of profile. It's telling you that things that we typically would like to see for a rally, about 90% of them are in place in round figures, or roughly speaking, and roughly 10% of the observable things that we would like to see have not occurred yet. There's no such thing as a perfect bull and bear market signal. That's why the CCM market model uses multiple inputs, multiple indices, multiple risk-reward ratios, multiple time frames, and uses multiple indicators and signals. This is one of them from a conceptual perspective. We're looking at the S&P 500 monthly. This is 1995. This is 2014. For those of you that are new to these concepts, these moving averages in blue and red help us discern between volatility to ignore, and volatility that requires defensive action. A full-bore bullish look from a probabilistic perspective is when price, the dotted line, is above both moving averages and blue is above red, and the slopes of both of the moving averages are up. Our bearish look is pretty much the opposite. Price is below both moving averages. Blue is below red and the slopes are down. Here, the probability, and the key word is probability, the probability of bad things happening increases, and we'd like to reduce risk until this look clears. Here, the probability of good things happening has increased, and we're willing to put capital in harm's way as long as this look remains. You can see here's a bearish cross that occurred in the year 2000, very, very early in the bear market. Full-bore bearish look telling us to reduce risk. Bad things did indeed happen. Full-bore bullish look here early in 2003, bullish cross. Probability of good things happening increased, and indeed, good things did happen. Probability of bad things happening has increased here in late 2007, and indeed, bad things did happen. Probability of good things happening. No signal is perfect. A little bit of a whipsaw here, but it got you back on track relatively soon, and that's why we use multiple indicators, multiple charts on multiple time frames. The current look of the chart sides with the bulls. We've got a full-bore bullish look. As long as it looks this way, it will check positive boxes in the CCM market model. We covered this chart in detail last week, so quickly we're still holding the bullish breakout. If you want to hear a description of this chart, you can visit the Shivako Capital channel on YouTube and watch last week's video. This week, the New York Stock Exchange Composite Index was up 0.83% or 86 points, and we're still above the blue line that acted as resistance here. We're all human. Our emotions make it difficult to be successful investors. One excuse or fear for not investing is that I can't buy at all-time highs. The S&P 500, by the way, made a new all-time high in Friday's session. As you can see here, in 1982, the stock market started making highs, new highs, and continued. So if you were afraid of buying at all-time highs here in 1994, you could have missed 6 years' worth of gains. This isn't a reason to buy, but it is not a reason not to buy. The observable evidence should be the reason to buy, and the observable evidence should be the reason to reduce risk or sell. We explain the concepts of using moving averages on the monthly chart of the New York Stock Exchange Composite Index. The exact same concepts apply to weekly charts, daily charts, and 60-minute charts. You can see here, as of the close on Friday, March 7th, we're maintaining a full-bore bullish look with a bullish breakout that's holding. The CCM market model has a deep bench, and it always makes decisions based upon the weight of the evidence, meaning conditions do not need to be perfect, nor are they ever perfect. So we examine the weight of the evidence. Same concepts apply with our moving averages here. These are weekly charts used by the CCM market model. This is more aggressive bonds, or I'm chasing yield relative to more conservative bonds. I'm more concerned about return of principal. Think of this as risk on versus risk off. You can see risk on is getting a full bore bullish look. This is stocks relative to more conservative bonds, risk on versus risk off. As of the close on Friday, improving with a full bore bullish look. This is market breadth. It looks at the number or percentage of stocks above their 200-day moving averages on the New York Stock Exchange. You can see we had some indecision here, but since the market model started buying in early February, the picture has improved on the breadth front. This one's easy. We've got the NASDAQ here, close March 7th, weekly, full bore bullish look from a weekly trend perspective. NYSE Composite holding this bullish breakout, improving here since early February. The Dow Jones Industrial also improving. We'd like to see the Dow and the Transportation Index make new weekly closing highs. Checking in on weekly momentum S&P 500, we know that the probability of good things happening is higher when momentum remains in overbought territory. Overbought territory, good things happen. When it drops out of overbought territory on a closing basis, the probability of bad things happening in stocks increases. As of the close on March 7th, we look good. We're in the probability of good things happening territory. As long as it maintains this look, it's checking bullish boxes in the CCM market model. Everything that we just said about the weekly chart of the S&P 500 applies to the weekly chart of the NASDAQ. The NASDAQ was up 0.65% this week and is maintaining a good things happen look from a momentum perspective. Now we're looking at the daily trend of the Dow Jones Industrial Average. Those of you that follow our writings and work know that three things have to happen for a trend change. Step one, You need price to break above a downward sloping trend line. Step 2, we need to make a higher low. And step 3, to confirm the trend change, we need to make a higher high. This is a good looking chart right here from a trend perspective. Does it mean we have to go up? Absolutely, positively. No, it speaks to probabilities. The probabilities of this rally continuing increase when all 3 steps have been completed. We're looking at the S&P 500 Equal Weight ETF, or RSP. This is a weekly chart, just showing some concepts here. This chart is not used in the CCM market model, but the concept of slopes is used regularly. You can see here, when the 50-week moving average, the slope turns up, the probability of good things happening increases. Notice the slope is up for several years. It flattens out here, goes up, rolls over here. The probability of bad things happening is increased, turns back up here. The probability of good things happening stays in place all the way till here in late 2007. And then indeed, bad things happened. Here in early 2009, you get your probabilistic bullish signal, and good things did happen. Currently, it has a bullish look. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.